Hi, and welcome back again to Option Optics, seeing what others don't. Taking a look at a plethora of vol capture trades on the metals company TMC, where some huge, unusual call buying spikes the IV to extremes yet again, setting up ideally for several different vol capture trades. So let's jump in and take a look, shall we? First of all, here's the scanner I built on the Thinkorswim website, and it identifies unusual option activity that spikes the implied volatility, right? Because if it doesn't really move the price of the options, it's not really as usable. But here you can see TMC showing up in numerous different spots as we take a look at the unusual option activity. Here you can see just more and more unusual option activity on TMC across the board. Also taking a look at a different scanner, right, that shows unusual option activity in kind of a combined form, not by individual strike. Here's the metals company, over 75,000 contracts traded Friday, right, which is triple the normal volume of about 23,000 or so. More importantly, we saw the IV jump over 9%, right, and now is trading at basically near the highs of the year. So selling option premiums certainly makes a lot more sense after this kind of move, right? It also makes more sense given that the stock, right, is starting to perk up here, right? We see this huge jump, right? Not quite at the, levels here, but certainly some overhead resistance, likely looming, stock getting overbought as well on many metrics. So this sets up for several different vol capture trades, a couple leaning bullishly, right, with that unusual call buying that we'll see in a second, a couple more just straightforward, more neutral vol capture trade. So as we said, all that unusual option activity spiked the IV. Here we can take a look at it right on a 60-day IV level. You can see that huge jump in implied volatility from Wednesday, where we saw a little creep up. Friday, a much bigger one. Here it is from Wednesday's close. We were closed Thursday for Thanksgiving. And then Friday, a massive jump in implied volatility, which means option prices are much more expensive on both the put and the call side. Here you can see the at the money IV over the past 20 days at by far the highest level, now over 133 on both the calls and the puts. Everything raised here, right? So certainly sets up for some good option selling, taking advantage of this big jump in IV. Here you can see that volume over 20,000 trade in December, 10,000 in January, right? You can see the percentage change across the board. IV percentile now at the 82% level, which given the fact that the VIX is back near 16, near the low end of implied volatility, this certainly is a bigger jump. And yeah, the commodity-based stocks usually tend to have that IV jump when you see a rise in the stock price, unlike regular stocks that usually see IV jump when you see the stocks head lower, right? Here you can see the call volume versus the put volume. Calls far outweighing puts, everyone rushing in to play for maybe a bigger breakout in TMC. We shall see. But as we said, the stock getting a little bit overbought. And if you look back over the past several times we saw these spikes in IV and saw the spikes in TMC, right? Both of them equated to tops in the stock, a reversion in IV, right? So this is now the highest level we've seen over the past 6 months. This is the slightly out of the money 40 delta 60-day call. You can see how that reversion took place when you see the spikes on the put side. Brought up the puts, 60 days slightly out of the money, 30 delta puts, right, were the same thing. These spikes in IV almost inevitably lead to a reversion. Both the puts and the calls trading at the highest IV over the past 6 months. So sets up ideally for several vol capture trades. One, here's the January 7 straddle, right, selling the Jan 7 call and put. The date I looked at going back was November 6th with the stock at $6, right? That Jan 7 straddle traded about $2.50 price there, right? Would have been about 7 deltas net long, right? You're selling an in the money put out of the money call, right? So a bullish trade, IV right around 105 or so. Fast forward to Friday, stock moved to basically the ideal price for selling a Jan 7 straddle. You want it at that strike price, the $7 strike price, right? But the price of the straddle jumped to 285, right, from 250. The delta flipped to slightly negative now, negative 19 deltas. Why? Because we saw this huge jump in implied volatility to over 140 as we just looked at, from 105, right, on this particular item. We can see that Jan 7 straddle from a theoretical perspective, right? Here it was on Friday's close at $1.41. If we move the price of the IV just down to 120, not all the way back down, right? We're not looking for it to collapse anywhere back down here, but just somewhere around the 120 level, right? We can see that that Jan 7 call, right, price would drop about 20 cents to $1.20 from $1.40. You can also see the delta on that option, everything else being equal, drops a couple points, right? Simply because of the drop in IV, the call delta becomes lower. On the put side, same thing on the price, right? We move the price from where it is now 144 IV roughly back down to 120, the price of the put drops about 25 cents, and the delta on the put actually increases, right? So that makes that sell straddle, right, actually much more of a neutral trade. Another way to approach it, the January 8-6 sell strangle, right, where you're a little further out of the money on both sides, right? 1 point up, 1 point down. So going back again to our November 6th kind of date, that stock at $6, selling the $6 put, right, at the money put, $8 call, would have brought in about $1.60. It'd be slightly bullish. IV at the time, about 105 days to expiration, 71. Fast forward to Friday, the stock again at the ideal price, equidistant between the $6 put and the $8 call, but yet that strangle increased from $1.60 to $2.12, right? Became slightly bearish now, right? Days to expiration now 49 days. So we've had a bunch of time peel off, right? Basically 3 weeks, which normally that should drop the price, right? As options approach expiration, they carry less time premium, but it actually got much more expensive. Why? Because the IV exploded to $1.51 from $1.04 before, so that sets up ideally for a sell strangle there. For those who want to do a more bullish sell strangle, selling the $7 put and the $9 call, so moving basically one strike up on both sides, right? Back on November 6th, right? The stock at $6, that strangle went out about 220, right? 23 deltas net long, so definitely bullish. IV at the time, right around the 111, 71 days to expiration. Fast forward to Friday, the stock at 696. So the $7 put still slightly in the money, basically at the money. $9 call still well out of the money. Yet that sell strangle increased in price from 220 to 235, has now turned slightly bearish, believe it or not. Why? Because the IV exploded from 111 to 146, even with time bleeding off the clock, right? Roughly 3 weeks, 22 days, right? The price of that strangle, even though it moved towards the ideal strike prices, right, got more expensive because of that jump in implied volatility. We can kind of do the same thing on the Theos here, right? Here it is from Friday's close, right? That strangles, we said, closed at about $2.35, right? With the IV roughly at 147-ish level, be 3 deltas net short officially, right? If we just move that IV basically back down from that 147 to 120 again, not going anywhere near where it was before, but about a 2/3 reversion, right? You can see that strangle theoretical drops to under $1.80 from 235. The delta actually turns slightly bullish, which, given the fact that the put is at the money and the call is out of the money, you'd expect to be the case here. So this provides a very nice edge on this trade of about 55 cents. Again, May 10 straddle if you want to get a little more, if you will, bullish here. So selling a deep in the money put and a well out of the money call back on November 6th with the stock at 6. That straddle would have been priced just under $6, would have been a bullish trade, 11 deltas net long. IV at the time back then, just under 118, 190 days to expiration. Fast forward to Friday's close, stock moved up to $7. Still, the put 3 points roughly in the money, the call 3 points out of the money, right? Yet the straddle price increased, right, from basically just under $6 to $6.40, turned bearish, believe it or not, simply because the IV exploded to 140 from 117. And remember, movements in IV affect pricing on a bigger price basis on longer term options. And again, we had those 22 days peel off. So time decay should have made the trade cheaper, but because IV exploded so much, it became more expensive. Take a look at the Theos there as well, right? The straddles we said priced right around that 640 level would have been 7 deltas net short, as we talked about, right? Simply because of the IV being at an extreme. If we just drop the IV back down towards where it was before, right, not all the way, we would see that straddle price dropping theoretically to $5.55, and the trade, the delta's flipping positive, which certainly makes sense given the fact the put is $3 in the money that you're selling. Selling an in the money put is a bullish trade, and the call is $3 out of the money. Still have plenty of room for this trade to run for those who want to kind of follow the trade in a more bullish way, right? Follow that huge call buy. Selling the May 10 straddle makes a lot of sense for that, right? You know that you have that bona fide edge going in, right, of about 75 cents or so on the trade. A little less bullish would be that May 9 straddle, right? Again, with the stock closed at $6 on November 6th. It would close at $5.25, the May 9 straddle, right? $9 put and call. So not quite as much in the money on the put and slightly less out of the money on the call. Would have been a bullish trade initially on this one, right? IV back then, right around 116, 190 days to expiration. Fast forward to Friday, stock at $7, still a very kind of nice price for the May 9 straddle, right? Moving towards 9, but you still have 2 points in the money on the put, 2 points out of the money on the call, but yet that May 9 straddle, right, jumped to 555 from 525, right? Even with time bleeding off 22 days, right? Flipped to a negative delta again. Why? Because of that huge jump in IV from 116 to 130. So that's set up ideally again if you want to kind of lean a little bullishly, right, but maybe not quite as much with the trade, right? Selling the May 9 straddle would be the way to go. So the straddle, as we said, here it was on Friday, priced at that kind of 565 level, 14 deltas net short. If we just drop the IV back down towards the 115 level, again, not at the level it was when all this started, right? But a reversion about 2/3, you'd see that straddle be priced at 5. So again, a very nice edge on that trade. So selling the May 9 straddle, a little less, if you will, bullish than the May 10, but both can certainly be a way to kind of more follow the call buying out there, right, than some of the other previous trades, which were a little more kind of vol capture, although the Jan 9-7 strangle, right, certainly is a more bullish way to play it as well. And then finally going out to February, the Feb strangle, right, 6-10 strangle, so going back again to November 6th, that stock at $6, selling the 6 put, the $10 call, would have been priced at $1.88 or so, would have been 7 deltas net long, a bullish trade. IV right around 110, and we would have had 106 days to expiration. Fast forward to Friday, stock at 696, right? So it's moving a little closer. The ideal price would be $8 on this, halfway between 6 and 10, right? Would be where you'd want the stock. So it's moving towards a better stock price. Time has bled off, right? 22 days, but the strangle actually jumped from $1.87 to 217, right? Why? This huge jump in implied volatility, and it also turned the trade from slightly bullish to slightly bearish trade, right? And we can take a look at the same thing here, that strangle, as we said, going from slightly bearish where it is now, right, with the IV at that 100 and roughly 40 level, right? If we just drop it back down to roughly 120, you can see that strangle theoretical $1.74, right? So a very nice edge of about 46 cents on the trade. So this is numerous ways to go about looking to capture implied volatility, right, on a stock that has seen big, unusual option activity, right? We saw the scan on this, 75,000 contracts traded, that huge jump in implied volatility, right, from Wednesday's close to Friday here, all predicated on the fact that we saw that huge call buying out there. So anyone looking to take advantage of this, here's more than one trade to kind of position either more neutrally, right, or if you want to do those in the money straddle sales, right, the May 10 and the May 9 certainly can benefit from the stock continuing to climb here. So until next time, as always, here's to good trading. Take care.